Thank you. So very nice to see you all. I'm Stephanie Léouzon from Stifel. I'm going to, and by the way, Stifel is an investment bank with a very strong presence in healthcare, biotech, M&A, partnering, and financing, and we've been quite active in the financing market in the last couple of weeks. I'm going to start by asking the panel to introduce themselves. So if we just go down, if you push the red button.
Good morning, everyone. My name is Asun Monfort. I work in HVM Partners. HVM is a healthcare specialist investment fund that is located here in Switzerland. We manage a 2 billion fund, and from this same vehicle, we invest both private and publicly. I work on the private equity team. Nice meeting you today.
This works. Hi, I'm Dimi. We won't go with the full name because it's too long. I'm a managing director at OrbiMed. OrbiMed's a just under $20 billion AUM healthcare specialist investor based out of New York. I sit in London, where I set up the office last year with my colleague Dina Chaya, and I look after the credit and royalty business in Europe.
Good morning. My name is Isabella Schidrich. I work for Nasdaq, so my role is to work with European companies supporting a listing on our US exchange. And looking forward to the discussion today. And I'm based in London.
Renée, Aguiar-Lucander. I'm the CEO of a company called Calliditas Therapeutics. We specialize in developing medications for rare disease. We're also actually duly listed both in the US and Europe, and have built up a company in Europe over the last kind of 7 years. I'm the CEO for the business, and I'll be looking forward to the conversation.
Sam Fazeli from Bloomberg Intelligence. We're a team of about 500 research analysts and editors, and we cover everything. And we're available to Bloomberg Terminal subscribers.
So I'll just walk briefly and quickly through a few slides, and then we can go with the panel discussion. So the big news is that the Federal Reserve in the U.S. cut interest rates by 50 basis points, so that's 0.5%. It's the first time in 4 years. And we'll talk a little bit more about why that matters. But you can see here, for example, on this graph, the blue line is the XBI, and the green line is the Treasury yield, so the interest rate. And you can see that there's kind of an inverse correlation between how the XBI, which is the big U.S. biotech index, how that index and how those share prices perform versus interest rates. So we're hoping that a reduction in interest rates will lead to a big upturn in biotech share performances. And we'll talk more about this, but there are 4 reasons why interest rate cuts matter for biotech. One is that it lowers the discount rate. So biotech typically has very long dated cash flows. So lowering that discount rate is important. It also lowers the risk premium associated with things like biotech, and can lead to an increase in consumer confidence overall, which is supportive for the sector and for the consumer-led elements, and also can lead to more M&A activity because of the lower discount rates and the perception that there's lower risk in the market. So the XBI last week, actually, it was a big week, but it was so well telegraphed that the interest rate cuts was coming that we didn't really see a big change last week specifically in the XBI. But year to date, the XBI is up about 14%, which is positive for investors. Investors are making money in the space, so they'll look for more opportunities. The other thing that's important is what we call the VIX, which is a volatility index. When that's very, very high, it tends to be very difficult for risky types of companies to finance. At the moment, it's now down to 16%, so that's a pretty low relatively to where it has been. And so we also look at the global biotech sector. I mean, it was basically flat last week, but 8% increase in the global sector in the last 2 months, and given this big expectation of interest rates. We also track things on what we call a disappearance adjusted basis. So we add new companies that have gone public, and we take out companies that have been acquired. And on that basis, the sector is up about 37% for the year to date. So it's been quite a strong performance. And we also look at just biotech companies that are worth more than $1 billion. So that has increased quite nicely this year. Up to about 9% of the companies now have an enterprise value of more than $1 billion. This is looking at Europe. I did have a slide. I had a little bit of a technical glitch. In the US, actually, interestingly, companies that are worth less than 100 million have really strongly outperformed. And in this case, in Europe, it has not been the same performance for the smaller cap companies since December 2023. So that's something we need to keep an eye on. But otherwise, the other companies in Europe are up quite nicely. Oh, that's another glitch. Oh, I pushed the wrong button. That's why. We also keep track of companies with negative enterprise value. So that's companies whose market cap is actually less than their cash, for example. And you can see that last year in 2023, at the bottom of this chart, there were a lot more companies in that position, and now it's really come back in again. The other thing that's important as we think about being able to finance is equity funds flow. So that's people putting money into healthcare-related funds. And as you look here on the right, that people have actually been taking, if you look at the chart across the piece, you see more or less negative outflows, basically. So that is really calming down now. And hopefully we're moving in a direction where we're going to start to have positive fund flows into those funds. So after months of very little activity, we actually priced 3 IPOs last week. Stifel was involved in 2 of them, and they performed very well, which is great. We were an active book runner on Bicara and on MBX. And then we also saw 2 other companies flip to what they call visible filings in the US. So it feels like the IPO market is perking up and is open for strong stories. And we're expecting that to come back in again, as we get closer to the election, and probably not, start again until later, but we'll talk about that with the panel. We are tracking to a slow year in biotech IPOs relative to what had been a more robust recent time for that. The follow-on market's very, very strong as well. Since Labor Day, more than $4.5 billion of follow-on issuance, and we seem to be on a path to a very, very active time. And this chart also shows if we annualize 2024, looking at 58 billion, which is, a big positive compared to the last 2 years. On the private venture equity side, it's been, pretty steady. Weekly volume of venture privates this year has averaged about 750 million. And, this month has been pretty consistent with that. But still meaningfully improved from 2023, for example, which was, a tough year. If we annualize 2024, it's looking better. Very robust private debt market at the moment, and Dimi can speak more about that. But we're really trending now to again, if we annualize 2024 to date, to a really, really almost a near record year in life science private debt issuance. M&A, on the other hand, has been very quiet. So last week we saw a couple of small deals happen. But even on an annualized basis, 71 billion of M&A is really, really low compared to what we've been seeing in the past. So we can talk again on the panel about why that might be the case. It's interesting to look also at this structured versus non-structured element of the M&A market. So we see, pretty consistently that there tends to be a much greater amount of non-structured deals. So that structured is when there's an amount paid up front and then, some form of milestones happen. But, that is something that's kind of evolved, as you can see, in the last, 10 years or so, that there's an increasing element of structure that can be put into these M&A transactions. Product collaborations also looking like on track. This is year to date, not annualized, 2024. So looking like we're on track for a continued very strong partnering environment. I'm going to skip that. This is also an interesting chart. Looking at the dark blue lines are the numbers of transactions less than 100 million. The gray bars are transactions from 100 million to less than $1 billion. the green bars are the 1 billion to 5 billion, and then the blue bars are 5 billion to 25 billion, for example. And it's interesting that this year, we just haven't had any, very large transactions, and they tend to be relatively focused in the sort of, 100 to 5 billion, 100 million to $5 billion range. I'll skip that. We talked about that. Oh, I'm hitting the wrong button again. Sorry. And in terms of M&A premia, we really haven't seen a lot of change. So when a company gets acquired, there's a control premium that's typically paid, and these are tracking it more or less in the last couple of years around 60 to 75%. 75% would be like on a 20-day median, and the 60 would be like on a one-day median. Okay, so I was going to ask people. So everyone's been talking about interest rates, and so finally we've had this cut. But do you think that matters, the interest rate environment? Sam, do you want to comment on that?
As always. I'd like to say yes, because your chart was quite convincing, except it stopped in 2019. I think that period where we went through the pandemic was a special period where generalists, who I think are much more interest rate sensitive than, or at least from a risk appetite perspective, than specialists, because that's what specialists do, they invest in our sector, came into healthcare biotech a lot more than they had previously. And that group is a lot more interest rate sensitive. And I think that correlation between the XBI and interest rates probably doesn't hold if you go further back. And I think the reason for that is that that's the one period where the journalists got involved, mostly driven by their excitement about how biotech can help, can do things that they that they hadn't thought of. For instance, the Modernas and Biotechs of this world, getting vaccines together, and the excitement of mRNA, etc. I don't think this matters. I think if they want to deploy money because risk appetite goes up, because risk-free goes down, they'll go to tech. Even if you tell me, Sam, who can explain to me what AI does? It doesn't matter. At the end of the day, they know that somebody's got to buy chips for AI. Somebody's got to buy machines for AI. They can understand that, calculate and follow those volumes. And everyone hopes that AI will increase productivity, etc., in the companies that utilize it. So that's not very hard for them to think about. However, when I bring a fourth ALK inhibitor that targets a specific mutation on a protein, I'm talking about Nuvalent, whose share price went up quite nicely and they raised $500 million, etc. What do I do with that as a generalist? So I'd like to think it will help. It might help a little bit on the margins. I don't think it's going to set the world alight for us in the biotech sector. Right. Fight me back.
Does anyone else have a view? Isabella, you mentioned you have a sort of IPO predictor tracking.
Yes.
If you hit your...
Sorry. So we have the Nasdaq IPO pulse, and the good news is that the pulse is on a 3-year high, and it's very much the bellwether for IPO activity. And so we looked at many data points, 50 plus data points, and we derived this index based on 6 key parameters. And one of the parameters is actually interest rates. And then another one is the S&P is index performance. So this is at a rise. So the indices are at an almost all-year high. And other parameters are the company evaluations. We look at here at the S&P 500 and enterprise valuation. Then we look at investor sentiment. We look at the VIX, the volatility index, which stands at 16. Typically, we see 80% of the IPOs looking at the market if the VIX is below 20. So the level is encouraging for IPO activity. And we look at our own data, so how many IPO applications we get in. So we look at these 6 data points, and interest rates is one of them. And if interest rates go down, so obviously this helps with the other parameters and the IPO pulse. So by having now this 3-year high of the IPO pulse, we are encouraged by the IPO activities, and that's why we believe interest rates coming down is a good sign.
Sam, we were talking earlier that if interest rates fall too far too quickly, it might panic people. Do you want to comment on why that matters?
Yeah, I mean, it's a double-edged sword. So, by the way, I'm not paid just to be controversial. So, but it helps, right? Double-edged sword in that I think Bloomberg Economics, which is part of the research group I was talking about, was calling for a 50 bips cut. I don't think that was the street expectation. Street expectation was a quarter point cut. So they had stuck their neck out, which often gets chopped off when you're an economist. This time it didn't. They were right. They're calling for another 50 bips before the year end and 100 next year. Now that may be too extreme. If that is the case and this comes to pass, that's the reason for it usually is that the Fed's scared of a recession. And when you're scared of a recession, that is not a good environment for investors in general. So that could, I hope it goes much more of a softer path in terms of interest rates. So, one thing I'd say, perhaps if as interest rates come down, maybe that entices generalists to invest more into funds, healthcare dedicated funds, so they utilize that expertise to then get access to the growth potential that we all know biotech has. So that could be a reason, but certainly not in my view the key driver.
Okay. I should say, by the way, if anyone has questions, please raise your hand. It typically tends to be a bit of a slow start for questions. Oh, yes, please.
Good morning, Christian from Switzerland. To exactly the point you're discussing right now, one key factor that I believe is relevant and I hear everywhere is the cheap money of the last 6-7 years, the zero or negative interest rates, money looking just for assets to get their margin out for the transaction or whatever. Isn't this year a challenge of a couple of years now ahead of us to wash out the market of not so really substantiated investments being made? The human brain works over experience. Present experience is factor 8 to 10 times higher than what happened 10 years ago. There are a lot of burned fingers and millions of dollars in companies that are closing down right now. The rest seems to be stable in the market. Are we seeing a washing out period in the next years even to come?
So I think you had a slide here, Stephanie, which was companies, life sciences businesses trading at negative EVs. And I think that kind of tells you exactly that, right? That you see that explode, particularly as we entered the rates hiking cycle. And you can see that there are still a huge number of companies trading at negative EVs. That's not a mistake in the markets, right? That's the market telling you that these companies have no value beyond their cash, or even worse. So that washing out, I think, still has to play out. And I think you're very right to say that's an important part of the cycle turning. And I think in the US, we're perhaps starting to see that. And I know we're going to come on to the IPO market, and maybe that's beginning to open again in the US. But I think in Europe, in classic fashion, we lag the US, and that washing out in Europe still to come.
I guess the only thing I would add is actually, if you think about all of the capital that was raised in kind of that period of time during the pandemic, that left companies able to kind of continue to run their business, whether they were valued below or above cash, because they had enough cash to kind of run their business. So I think what you have seen is that kind of washing out started maybe 18 months after kind of that period of time, when they were literally running out of cash and they were not able to kind of replenish their the coffers in the same way. And I think that's also why you've seen the debt market, to Dimi's point. I mean, I think companies have had to go to different sources of capital than just the pure play kind of equity markets. But I do think actually in Europe, because there was never as much money in Europe as there was in the US, I would actually argue that a lot of that has already happened in Europe. I don't think we have a lot of companies left in Europe that still has kind of capital, from what they raised several years ago, because European companies never tend to really raise that amount of money. I do think in the US there might still be happening, but in Europe I would argue that's probably already gone.
if I might say something, I totally agree that there has been a market correction in the last couple of years, but I don't think the expectation is the interest rate will go down that low again. Rather, they will stabilize around 3.5%. I think that's the expectation now.
Stephanie, one of these days, we're going to start with the positive, right?
I was trying to start with the positive. Any other questions? Okay, well, why don't we go on to the IPO market? So Isabella, you're seeing increased interest. I've always found over the years that, as Dimi said, you need to see a wave starting in the US, and then as that wave gets going, then you might be able to get some European companies onto Nasdaq, and the local markets are really very, very difficult to raise money on. So are you seeing more increase in interest?
Yes, absolutely.
Or is it too early?
I mean, we have been in a hiatus for the last 2 years, and obviously the big parties were in 2000 and 2001, and especially in 2021, where we seen over 1,000 IPOs, 1,033 IPOs. So obviously this is a far cry away what we have seen then in the following 2 years with around 180 and 158 IPOs. And this year, to date, we had 140 IPOs raising 29 billion. 30 of those were SPAC business combinations, the rest, SPAC companies, the rest were operating companies. And we've seen amongst these operating companies 27 healthcare companies, of which were 14 biotech. And this was actually the highest count in IPOs if you look at industry sector split. This was then followed by industrial companies around, we had 23 industrial companies, 20 technology companies, then 19 consumer, and then it goes down in financial services and 2 material and 1 energy company. So healthcare was leading actually the IPO count, and we found this encouraging. And if you look over the number of years or past years, so the IPO count was always driven by healthcare, technology companies, and fintech companies in the US, financial services companies. And then we are also encouraged by the backlog of IPO companies wanting to come to the market. So we look at here at the SEC filings, and here we have 220 SEC filers. And here the count is driven by consumer companies, 58, 50 technology companies, 30 healthcare companies. So all these companies which filed with the SEC, they plan to come out at some point in time. Obviously, the markets need to be aligned, the valuations need to be there for companies. And so we are encouraged, as I mentioned earlier on, with the Nasdaq IPO pulse and with the backlog, the IPO count to date, that 2025 can be a better market. But obviously the macroeconomics need to be there, the geopolitical landscape needs to be there. So there are still some uncertainties, but at least, the backlog is there.
I was going to ask, because Renée's just been on this wonderful journey of Calliditas, and you actually went public in Europe first and then did a US listing. A number of companies are thinking about just going straight to Nasdaq, and I'd love to have some of that conversation, but based on your experience, Renée, Asun, maybe what you're looking at for the portfolio, and Isabella, what your thoughts are on that.
Sure. So yes, this was in 2017, 2018, when I kind of joined as CEO of the company. I actually did look at kind of a variety of different things. I think in order to go public in the US, though, you actually, in my view, you definitely need already some US institutions in your stock. It's very difficult, if not impossible, to just kind of have a completely European shareholder base and then kind of do a successful offering on Nasdaq. So actually, from that perspective, the options really were to kind of go with a private round of kind of US investors, or to then kind of take the company public in Europe. And because we were a little bit in a hurry, we were hoping to kind of start running a global phase 3 as soon as possible. There really was, these were really the options that we had just from also a timing perspective. The shareholder base at the time was very European, and so really kind of it was the shareholders' choice to really kind of take the company public in Europe, and which we did successfully. I think we were the second largest IPO in 2018, actually, when we raised the money, at about $80 million that we raised at that time. We then actually went public in the US for a key reason, which was we actually decided early on strategically to sell the drug ourselves in the US, should it be approved. And so really from an operational, regulatory compliance perspective, having a listing in the US was actually for us less about, suddenly the company's going to be completely revalued and, we'll have completely different things, which is probably, it's very unlikely that will happen. It really was for operational reasons. We wanted to really hire a full team, and we now obviously have a fully fledged commercial infrastructure in the US. And also just from all of the things you have to go through in order to kind of just apply for lots of permits and things in the US, it is a lot easier if you have a listing, because everybody knows that you have US lawyers crawling all over you on a daily basis. You have very kind of strict disclosure rules, et cetera. So it makes everybody feel much more comfortable than trying to explain to them where Sweden is, and Sweden's not Switzerland, and no, I don't go skiing, and it's a long conversation. So basically that you just avoid all of those issues by having that listing. And so I think for us, it has been really important, but I would say more from that perspective than from a pure kind of valuation perspective. But obviously it does ultimately give you access to a much deeper capital market. And we were obviously able to raise significant amount of funds when we did the IPO. So it's not to say that it's not important from fundraising perspective. It definitely is. But for us, we didn't have the luxury of kind of saying, should we go to Nasdaq or should we go to in Europe?
And Asun, for your companies in Europe, do you think about taking them public in Europe?
Not really. Our strategy is always to try to exit the companies in the US, and then for this we co-syndicate always with US investors as well. And the reason is what she already mentioned, that there is more liquidity. The valuation of the company is also higher in the US versus in Europe, and there are more specialist investors in the US. So we try to set everything around the company so that they can think of a US Nasdaq IPO.
And there is a long list of preparation that needs to be done. Isabella, you mentioned you thought you should start 2 years ahead of time?
Yeah, absolutely. So, the IPO is obviously a process itself. It's a well-trodden path which a company can complete within 9 to 12 months, probably 9 months if the company is already public on a local market, simply because then the accounts are already audited, and this takes out 3 months of the preparation process. So it makes it easier from this perspective as well to go for a US listing. But I work with both. So companies which are already listed on a local market going for a US listing, or companies which go straight from private to public, so with a primary listing in the US. But the IPO process is one activity, because it's very much set in stone. Once you have your audited financials, then you appoint your IPO advisory team, you kick off the SEC filing. Then after the first draft of the SEC filing, you kick off the Nasdaq application process, and then you go through the second and maybe even third draft of the SEC filing, and then you flip public, so you become SEC effective, you go on the roadshow, and then you price prior to day of the first trading day. So this is very well defined, but it doesn't really mean that a company is IPO ready. And with readiness, it requires a lot of preparation, and Renée indicated that. And we typically recommend companies to become IPO ready really 2 years out, 18 months out of the process. And one key component of the readiness is to have this dialogue with institutional investors. It's almost too late, if you kick off the IPO process and then have your test the water meetings and then you have your US roadshow. You need really to have this dialogue with institutional investors, and they need to have confidence in you as a company that you deliver your milestone you set out to. And you can only establish this confidence and transparency if you have regular meetings with institutional investors. So I think this is one key component of having a successful IPO, is really having this strong dialogue with investors. And we help companies reach out with investors and build up this dialogue. But another key component is obviously having a strong equity story. And this doesn't stop then with the IPO. It really needs to continue for the next 2 years, because investors want to hear what's the growth of the company, what drives the growth, and ultimately then the revenues and profitability. So this is an important component. And, obviously all the financial reporting needs to be in place. The SEC filing needs to be in place, the corporate governance, the board. Is the board you have, really fit for purpose, have the right skills? And, it's not a good idea just to scramble together a board during the IPO process. So it really the board needs to come together and have the right skills. And another consideration is, where is the company incorporated? Is it in the local market or is it in the US? The incorporation is an important decision, simply because, at some point in time you need to offer a financial instrument in the US market, and then you have a big decision: is it an ADR program or is it an ordinary share program? And not per se the incorporation part defines which instrument you can offer, but the settlement system which operates in the country you are incorporated in. So the settlement system is, you could be Euroclear if you're a Belgian company, Euroclear Belgium, or French company, Euroclear France, or in Switzerland is SIX SIS. And these settlement system very much define, whether there is a link with the US clearing system, which is the DTCC, Depository Trust and Clearing Corporation, and whether these settlement system can communicate defines then, whether you can offer ordinary shares or ADRs.
So there's a lot of complexity to think through,
Exactly.
it sounds like.
So these are considerations which really need to be taken into account in the, well ahead of the IPO process.
Sorry, any other questions at the moment? So why don't we move on a little bit? Oh, go ahead, please.
Just one comment, I think, on the whole kind of, and just to be a little bit controversial, because we don't want to leave you being the only one to be controversial. Is the other thing, obviously, the more you can look like you are a US company, the better it is, right? It's a very simple kind of strategy. Is obviously, it's always much harder. It's going to be hard anyway, because actually one of the key things that you're always going to be fighting with is that if you didn't grow up in the US, and I mean literally, you didn't go to college, you didn't play lacrosse, you don't have your networks established, right? That will always be much, much more difficult for you, because this is a clubby environment. And if you haven't noticed already, it's a pretty clubby environment, the whole investment business in the US. And so having to be kind of having an ADS is obviously going to be worse than just having ordinary shares. Going directly to Nasdaq is easier than doing a dual listing with Nasdaq. But I think at the end of the day, right, when things get tough and kind of money gets a bit scarce, I think, generally European companies who are not part of that kind of club is going to get kind of lost first. So I think it's always going to be a bit of a challenge trying to kind of list in the US. And it's not just the technicalities that you have to think about. It's actually also how you're going to be perceived, and what are your real networks, and what are the depth of those networks. And so I think we shouldn't kind of kid ourselves that just because we do a listing in the US, all the problems are solved. I don't think that's the case.
Yeah, if I only can comment on it, Renée made an important point here. It's to feel, if you go as a European company or non-US company for a US listing, you really need to look and feel like a US domestic company. So many conversations we have with, French, Swiss, UK companies and or Italian companies, and there's always a pride. We are the first Italian company going for this US listing, from a certain sector. But, being an Italian or French or Swiss company is not the differentiator going for a US listing. So it's really feel and look like a US domestic. I think this was an excellent point. Yeah.
Hi there.
Do you see an increasing trend, more competition for the IPO, for the filing, the stock market kind of going public from private equity going earlier, having deeper pockets now? They sit on a lot of cash, and actually they can make also the life, concentrating on your science, getting the product approved, much easier, because what you all describe sounds beautiful, but it's a big burden if you're a company of 7 or 8 people.
Yeah, it definitely delays. So there's money out there. Private equity has the money to fund companies, and this obviously delays the IPO stage of companies. So, and then if you look, at the valuations of these companies, which are valued privately, and then over the last couple of years, what they would have been valued publicly. So there was obviously a disconnect, but there is always an encouraging side. We see lots of secondaries in the market, so public companies raising. And so these valuations are going up. And with that, there is parity now with private equity valuations, secondaries. And this could be, again, encouraging for IPOs. I mean, we have been in a tough market for the last 2 years. Yeah.
And it's interesting also, Dimi, your timing for starting up in Europe with your business is interesting, because given the tough times in the market, that may have created some interesting opportunities and more willingness to accept different approaches.
Yeah, I think that was always part of the thesis for bringing the business over at this time rather than another. I think it's undeniable that there's a cyclicality to that, which is that equity fundraising has been difficult, and so businesses, management teams, boards have to think about some of these alternatives, and you can sort of see that in the figures for kind of private credit, structured credit, whatever you want to call it, in the life sciences market over the past few years. I think, though, it's also important to add to that there is a secular trend there, which is that whilst there will naturally be a sort of ebb and flow alongside equity markets, there is also just increased volume. There are more assets coming to market that are being commercialized by biotechs rather than being taken out earlier. It's a trend that's already pretty mature in the US, and it's one that seems to be growing in Europe alongside very much a renewed recognition in Europe amongst the sort of smaller to mid-sized pharma biotechs, the more mature businesses, that these sort of structured products and royalty structures that are fundamentally non-dilutive or less dilutive kind of have a very interesting value proposition for their shareholders. To sort of use an example we've got on the panel, if you look at, Renée used non-dilutive financing at Calliditas very successfully. And it was no impediment to a very successful exit of the business. And if anything, I might say that if you look at the refinancing you did kind of last year, and if you look at what the value accretion of that financing to shareholders versus doing an equity fundraise at that time, when you look at the premium of the takeout, that was enormously accretive to shareholders doing that deal. So I think there is a secular sort of trend towards recognition that these structures have value, but it's to sort of come back in a rambling way to your point, Stephanie, that has been accelerated by this kind of cyclical element of just a difficult equity environment.
And just so people understand, what is the kind of profile of company that you would consider?
So where we start to get interested is commercial or near commercial businesses. So we're talking later stage businesses that are in or approaching a kind of scale up. So the classic is a biotech that has its novel asset and it's coming up to launch. You're somewhere around approval. You filed, you're somewhere near approval, or you're just post-approval. And the financing is really to accelerate and aid that commercialization of the product. It can also sometimes be, if it's an out-licensed product, to monetize or kind of upfront some of those royalty proceeds to help the business reinvest in the future pipeline. That's the kind of classic profile, but it can sort of flex a lot either way from that. It's sort of the beauty of the capital is that it's very flexible.
I'd just like to add a little bit to this. It's interesting in that the dogma in biotech is that when a drug comes up for launch, usually those who can, i.e. hedge funds mostly, short the stock because most launches disappoint. In a normal biotech world, you get a great disappoint in terms of everyone's analysts are so super excited about stuff often that it doesn't quite match up to their expectations. So if you have a phase 2 data that comes out, there's euphoria, you can raise money at a premium. Phase 3 data, euphoria, you raise money. Not on a launch. So ideally, you want to be well-financed going into a launch, not needing to go and raise money around the launch. I mean, this is not set in stone, but one of the attractiveness of these kind of structures is that. And I wanted to do very quick maths. Isabella, you said there was 1,000 IPOs in 2021. Let's say 30% were biotech. Let's say each had 2 assets. That's 600 drugs. 600 drugs amongst in 1 year, looking for money to develop. And I'm pretty sure if you did the large pharma 10 companies, their pipeline wouldn't be 60 drugs each. It'd be perhaps that sort of number. But they spend between $70 to $80 billion a year on R&D. Those assets, it's impossible to finance that with the public market. So excellent for licensing and excellent for these kind of deals. So I think, I don't know, do you see a higher flow, a higher number of opportunities for royalty financing, licensing? I mean, licensing has always been heavy and busy, and it's been, your chart showed it. Our data shows the same thing. Do you see that reflected in your data?
Yes, is the short answer. So, we can see year on year the volumes of these deals are just growing, both in the US and in Europe. But Europe's just starting from a lower base, and the growth rate is higher. It's probably the simplest way to put it.
And can we use that as a positive? If there is money and interest either from pharma companies or from private equity to finance the good assets?
No, I think that's absolutely the case. And there is more and more of this form of capital coming into the market and coming into Europe. So I think we can just about.
Sorry, we're coming up to about 5 minutes left. Any other questions from the floor? Okay, then does anyone want to speculate on what, we have seen, Renee, you've had an amazing M&A transaction this year, but it's been a really quiet year. Any speculations around why that is?
Interest rates? Uncertainty. We had IRA, we have an election. I think I put more on IRA than election. And, pharma companies.
Do you want to explain IRA?
Oh, sorry, the Inflation Reduction Act. The very clever system of calling drug price controls and a whole bunch of other stuff related to reducing inflation. I mean, you can work the maths to suggest that that might be the case, but it's pretty much bringing the US into line with other countries where the government negotiates prices on certain drugs. I'd be surprised if somebody here, unless you're in the medtech business, I don't know, that doesn't know that. And the first set of drugs prices were announced, and in fact, it wasn't that bad. The reason often is because this time people didn't worry about it, but what I'm worried about is that this is just the start, that the next round will be harsher, and it will be applying to drugs that are not about to go off patent anyway, which was the majority of the drugs that came around this time. So we know the price is set for the next time. But in any case, the stupidity, sorry, I can say that, of it is that it differentiates, or I want a better word than that. It is not good for small drugs. Help me.
Small molecules.
Yeah, small molecules, but there's a better word than that. It's 9 years is all you get before negotiation starts. For a small drug, 12 years, or is it 13? I can't remember now, for a biologic. I mean, that makes no sense at all, right? I don't think there is a reason to believe that small drugs are easier to develop. In fact, often the opposite. So why do you do that? And a lot of drugs and diseases in the, especially in neuro, which is where there's a huge amount of unmet need, often are small drugs. So it just doesn't add up, really. And there's definitions about orphan drug status that are not clear. But anyway, I think that was the reason. And I'm going to predict that M&A activity will go up in the next quarter because there's no other direction it can go. We've had pretty much nothing in the last quarter, right? So.
True.
But I also think that, I mean, we've just talked about this in general, though, that, whether you're a big pharma or a medium-sized pharma and you're considering, doing M&A, are you in a hurry? I mean, what other options are there really? I mean, so I think that a lot of times there is no real sense of urgency to do things now. Why not do another round of diligence, right? Why not kind of talk to some more KOLs? Why not kind of because what you're doing is obviously you're also trying to assess, what's the optionality on the other side, right? What can potentially happen with this company? What does this company have as other options? So I think there has been a little bit of a molasses in the whole kind of deal-making process because there are very few kind of catalysts that will say, well, actually, I should do this now. So I do think actually that's one of the things that I think it is going to go up. But I also think this is actually where interest rates might actually kind of make a difference because even as a stance, I think companies can kind of now, have a different, maybe, different story at least of kind of what might happen. So I think that the lack of alternatives or kind of sense of urgency, I think have mattered.
I see a question out in the audience, maybe.
Pekka Simula from Innovestor Life Science Fund. What kind of deals do you think that Big Pharma has appetite for? Because looking at the big picture, it's like Novo and Lilly are growing, but the others are kind of struggling to grow their revenues. So what are the Big Pharma companies hungry for?
I mean, I can probably give at least one opinion on this, which is that I've heard a couple of people say to me over the last year that, the new $1 billion blockbuster is now a $5 billion blockbuster. And I think this is going to be an issue for a lot of biotechs coming through, which is that Big Pharma now, the products they're after in terms of commercial scale are just so much larger. And it's going to cause an issue for exits for any drugs that are smaller than that. Just in terms of inflation of what Big Pharma are looking for in terms of peak revenues.
Maybe I can add also something here. There has not been only a decrease in the number of M&A activity, but apparently mainly is the amount of money that is deployed in these M&A transactions. They have been much smaller this year. And apparently that has been also a shift, the big pharma going to look for assets into the private companies, not anymore into the public companies. This means they can acquire the assets at a lower price as well. Everything comes together also because the companies were not IPO in the last 2 years, so they were maturing, they have more mature assets, they're still private, but the prices are still low. So I think it puts everything together in a circle.
Anything else? We have one more minute. Yes? In the back?
I like the idea of the 5 billion story, but frankly, a lot of big pharma companies can't even see what could become a $5 billion company. And that typically is the Actelion story.
They can. Most of the drugs are going to be 5 billion. At least that's what they tell us, right? When you look at any presentation to 2030, 3 billion plus, etc.
I mean, I think it's, in a sense, it's a fair and obvious comment, right? If we all knew what would be, the next whatever GLP-1, we'd all be incredibly wealthy. But I think the point is more that the scale of the cash flows and the businesses that are dropping off at Big Pharma, these have to be replaced. And if you think in theory, the same amount of diligence goes into buying, a peak $100 million drug as a $1 billion drug. You have to buy a lot of $100 million drugs to pick up some of this cliff that's coming up, and it isn't feasible. So, big pharma need to find these big products.
And I would agree with that. Actually, I also do think that that's why. I mean, if it's not going to be, one large kind of, one drug with a huge kind of potential, at least they have to feel that they have a scientific basis for maybe launching several different products in kind of related areas so that they can get there, but with one program, if you want to call it that, rather than kind of with several different programs. And I think that the challenge for kind of biotech, and I think particularly in Europe, where you don't have the same amount of capital accessibility necessarily, is that is leading them into very large indications, right? So we're back to looking at things like cardiovascular and neurology. I mean, all of these things they are difficult. They're big trials. They're expensive trials. It's hard to do, right? But obviously, this is where you're going to go into bigger indications, less focus potentially on orphan and rare, and some of these things where it is more possible or feasible for smaller companies to be successful in that. So I think that's going to be the challenge, both for them to find them, and also I think just to develop in these very large indications, which is why everyone's falling all over themselves, obviously, with GLP-1s, because how many of those drugs are we going to have in the next couple of years? But I think that's why you're seeing that shift from pharma, and you're not seeing them buying lots and lots of smaller companies, because I agree. I think it may not solve their problem.
So with that, we're at the end of our time. I'd just like to thank everybody on the panel, and thank you all for joining us.